Welcome to Barchart series of educational webinars. Today's subject, gap trading strategies. Now, in the battle of price discovery, gaps represent the largest imbalance between buyers and sellers. And these powerful markers are your golden ticket to spotting emerging trends, amplifying ongoing movements, and predicting pivotal reversals. Though not all gaps are created equal, each has a unique narrative to share, and understanding how to distinguish the signal from the noise is paramount to gap trading. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist, and today I want to dive into the exciting realm of market analysis of gaps and uncover some trading opportunities I believe many others miss. Now we're going to look at several types of gaps, their importance in trend analysis, how they can offer clues to strength, magnitude, and potential reversal of trends. We'll discover there's a cycle to gaps and how to discover the breakaway gap, the first and most powerful gap in terms of potential profit, using our bar charts gap up and gap down page. And finally, with time permitting, we'll finish with training our eye to find hidden gaps, something called an inside gap. Now, some of these gaps might not be of imbalances, but they still offer some lucrative trading opportunities. So to help me with today's session is our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Hi, John. How are you? It's been a while since we've been together for a webinar here, so nice to hear your voice again.
Yeah, like a dog's age, right?
Yeah, okay.
So, Jean, what's the national day today?
Oh, gee, you caught me with nothing. It's National John Rowland Day. How's that?
I'll stop it. Okay. I didn't mean to do that to you. I know you're always on top of that. So, all right. You ready to get started then, Jean?
Yes, let's get going.
Okay, great. All right, just want to remind you that today's session is for educational purposes only, and decisions to buy, sell, or hold or trade securities or commodities or any other investment involves risk and investment made by advice of a qualified financial professional. And day trading involves particularly high risk. It can result in the loss of substantial sum of money, and that the strategies that I'm going to put forth, there's no guarantee that they will result in profits. And so under no circumstances shall we be liable for any loss or damages you or anyone else incurs as a result of any trading activity or investment activity that you or anyone engages in based on the information that you receive through barchart.com and our services. Okay, so let's start with a little bit of gap theory. And I'm going to start with a question. If I were to ask you, does price rise because of buying or lack of selling? Now, hold on to that thought for a moment. Now, a gap is a void of price, meaning that in the equation of price discovery, one side of the equation equals zero. Therefore, prices rise because of lack of selling. A gap is an absence of buyers or sellers. Now, we're going to learn or look at how to identify opportunities based on what price does after a gap and when price returns to a gap. Now, price remembers gaps, and in theory, it wants to fill the gap. Candlestick theory tells us that gaps are called windows and act as levels of support and resistance. And a gap could offer us a second chance to enter into an already established trend or enter into a newly created trend. And there's an order to gaps, a vernacular to gaps. which is not always apparent, but when discernible can be very advantageous to the trader. So let's look at some different types of gaps and discuss their characteristics and their implications. All right, so we have something that's called an opening gap or an outside gap. These gaps, the opening price of the new bar opens outside of the previous bar's range. Now, these common gaps are easy to see on our charts because there's this visible void of price. Now, a partial retracement and return to the highs of this breakaway bar signifies a continuation of the gap's direction. And we're going to refer to these as kind of gap and goes. Now, kind of a general rule you can use here is if we do not see price fill the gap, let's say within the first half an hour or hour of trading, then this increases the odds of a continuation of price. Now, a full retracement and a failure to regain the opening range is a confirmation that the current price direction, or that this is a failed a gap or failed breakaway. Now, we could have a full retracement that regains the opening range, and this would be a confirmation that current price direction is going to continue as well. Now, if we find one of these common gaps inside an area of consolidation, now these usually represent a short-term price reversal. So from there, we can talk about something called a breakaway gap. Now, these are the most profitable type of gaps because they signal the beginning of trends. The key, though, is for us is finding those that break away from a range of price or structure. Now, a flag or a pendant, for instance, or let's say a penetration of a classic chart pattern, a head and shoulders, or a trend line break. Now, breakaway gaps are outside gaps, these gaps and goes. In other words, we want to look for those where price does not retrace immediately. Now, their significance is that in the right context, they identify the origins of new trends and could be major changes in trends. Now, the size of the gap may be proportional to the strength of the sequential price movement. Now, I believe that it's not the size of the gap, but the reaction of price after the gap. Now, some clues that we can look for breakout gaps is volume can offer us. And there is, if we have a large amount of volume prior to or at the inception of the gap, but relatively low volume after the gap, then the odds are kind of 50-50 that we could see a quick retracement back to the edge of that gap. Now, that retracement could be partial or full. Now, high volumes after a gap increases the odds of continuation and lowers the chance of a pullback. Now, if we do see a pullback in this scenario, then typically the price will stop at the edge of the gap. All right, so let's do this. Let's go to a couple examples. So what I did is I created a watch list for today's session, and I just threw in some different stocks in here that I was noticing some gap so that we can do some analysis together. So here's Apple, and So first of all, what do we say? That there are gaps that can be found in structure or in a range of price, these common gaps. And you can see that there's one little one here, there's a little one here, there's one here, there's one here. And these are usually referred to as short-term price reversal gaps. Now, typically what we'll do is we're going to ignore these gaps that are inside of these structures. But when we start looking at price breaking out of one of these structures, and we can start looking at volume, right? For instance, here we can see a breakaway gap, that price gapped away from our channel here, and it happened on high volume. So that usually tells us that there is some good momentum in it. But because the volume did not continue after the breakaway gap, that increases that odds that we're going to get some kind of a retracement, that 50-50%. Now, in this case, it took several days, but you can see that price did come back and retest that gap. Over here, we can see that we have a breakaway gap with post volume. Again, that is a signal of continuation and not a retracement. And you can see that here we had that large volume on the breakaway, but again, continuation of higher volume in terms of an average as price continued to move lower. Again, increasing the odds. Now, before I move away from this chart, this is why I really like gaps, or why I like the story that gaps are telling us. So here's a blue line that just represents a trend line, right? It's, we all can just draw trend lines. And again, trend lines are subjective, but you can just see here, prices here. If we believe this is an uptrend, and we think about what a gap represents, right? A void of buyers or a void of sellers, and buyers are in control in this uptrend, would the market be allowed to make a gap lower? In other words, an absence of buyers. So this would have been our first clue that there was something going on in Apple. Now, maybe that might be just short-lived, but the fact that we then created another gap based on our structure, right, broke away. And also, if you look at this low here on this gap, the beginning of this gap was where we came back and filled from previous gap. So this break of structure, break of trend line would have been a real confirmation that this trend in Apple is over. And that's why I really like the story the gaps are going to tell us. All right, so we have something called a runaway gap, which is a continuation gap. Now, these are usually placed in areas of continuation or acceleration. And what you'll discover is there's limited pauses or corrections or pullbacks or drawbacks, however you want to define that. Now, these gaps are less frequent than, let's say, our common gaps or breakaway gaps, but they do have a greater technical significance and are an indication of the probable extent of the move that we could see. And that's why they're sometimes referred to as measuring gaps, because typically they fall about halfway through our trend movement, like from our beginning to our peak. Now, I'm also going to show you a technique how we can measure a runaway gap itself, similar to like where we measure a flagpole for a flag or a pendant, and use that measurement to extrapolate the next price movement. So let's look at that. So here we can see this is Celsius, and I just want to kind of show you, right? Here's our structure. We were sideways action for a long, long period of time. And then finally, we got that breakaway gap, right? That breakaway gap on volume. And then we had another gap here where right after that gap, we didn't have much of a pullback, right? Not many pullbacks, right? Kind of one direction. So there's two theories here. One is we can measure the length from the beginning of the breakaway gap to its peak, and then from the runaway gap, we measure that length, and then that will help project for us because the runaway gap comes about halfway through our trend. That can help us project a potential topping action, or where we might find that we think the trend will run out of a little bit of steam. Or what we can do is we can do like we do with pennants and flags, is we measure the flagpole of the gap, in this case where we broke out into the high of that gap, and then again extrapolate from there as a potential target. So why we call these measuring gaps and when we can discern them really gives us a great assessment of how far we think price can run, how much profit we can take, and also help us to define, our risk reward relationships. So here's Tesla, and again, I want to kind of reconfirm this with you. So let me go to 6 months. And again, notice what we said. Here's our kind of our breakaway gap. And then notice what we see with our volume after our breakaway gap, right? We see a continuation of greater volume. That is a confirmation that we're going to see a continuation of this trend. I mean, this is basic technical analysis, right? Rising volume is a supporter of a trend action. But here we can see in here, let me get rid of the volume here for a second. These little red arrows are little runaway gaps, right? And so we had a series of them, kind of a straight line action. Again, we can use this as a measuring tool, right? So we go from our peak to our runaway, and then from our runaway, next runaway gap, and extrapolate how far we anticipate this trend would go, about halfway through. And you can see that was a pretty good a predictor of price movement. So runaway gaps can be one, or they can be a series of this, what we call like this straight line gap. All right, so we have what is called an exhaustion gap. Now, an exhaustion gap is very similar in characteristics to our runaway gaps, and it's difficult for us to distinguish them at the time that they're being created because of the characteristics or similarities to a runaway gaps. In other words, rapid price movement, extensive advances or declines in that price action. And it's not until after price returns and fills that gap that can we say that this gap was an exhaustion gap. Now, they rarely come after breakaway gaps, but rather after a succession of runaway gaps. Now, the more runaway gaps you create, the higher the probability the next runaway gap is going to be an exhaustion gap. Now, these gaps are quickly filled, right, are quickly closed. And that usually happens within 2 to 5 bars, or if we're looking at a daily chart, within 2 to 5 days, within about a week. Now, this signals that the trend has run its course. By itself, it does not necessarily mean this is going to be a reversal of a trend or a major change in a trend. It's just telling us that this trend has come to an end, and this is kind of telling us there's a hard stop to this trend. Now, price could do a couple things. It could reverse, or it could consolidate for a while, gather energy, and then re-engage the previous trend. Now, that does typically occur with another breakaway gap. So here's Adobe, and you can see our breakaway down here, then runaway, right? 2 runaways, and then we get that exhaustion gap. Of course, it's difficult at this time when this gap was created for us to say that this is a runaway gap or a breakaway gap. But what we can see within 2 days, price comes back and fills that gap. So that's would be an exhaustion gap. Now, what I said is that it's not as significant in terms of a reversal pattern. It's just telling us that this trend in price has come to an end. And now, notice on this one, right? Yeah, price did back off, and we look at this in terms of a percentage, almost 9%. That was a bit of a correction, but in terms of the bigger picture, right, the trend did not fail, right? It just paused for a while, and then we can see that Adobe eventually went back up again. Again, let's look at Western Digital. Here we have an exhaustion gap to the downside, right? We have this gap down, and within 1 day, you can see price came back and filled that gap. Remember, I said that it's not necessarily a significance at the time that it's being created. It is only afterwards, where we had a retest of this low, that this became more of a significant bottom. And in this case, the reversal did come on a breakaway gap. So a lot of times after an exhaustion gap, you have a period of consolidation, and then you get a new gap, either a breakaway of a new trend or a re-engagement of the previous trend. So there are some clues in terms of exhaustion gaps forming, usually periods of high volume. And again, this concept that price retraces or fills that void within, a few candles. Now there's a variation of an exhaustion gap, and that is called an island reversal gap. Now these can be described as reversals in price action. Now they're not very common, and they're not necessarily a significant reversal, but there is a rule that if you have a reversal candle, island reversal, that price will go back to or complete a retracement from the last price movement. And that could be in the short or intermediate time frame. Now, island reversals are this combination of a exhaustion gap and a new breakaway gap, or a reversal of gap. Now, they can be compact and fast and have high volume, but those that are of extended time, in other words, there's a long period of time between the exhaustion and then the new breakaway, and if we have low volume and low volatility during that, then these potentially or frequently turn into a larger pattern and a turning point. The other thing is island gaps is we should see the gaps should overlap. So let me again give you a couple of examples of that. So let's see, here we go back to our flip charts. Amazon. And so here you can see an island reversal gap, right? Gap up, gap down, 1 day, right? Big price movement. Now, in this case, and what is in these rapid island reversals, there's a couple things that could be catalysts to us. And one of the catalysts that definitely can create these types of islands is earnings. And you can see that here. Now, if I added volume to this, you will also see a large amounts of volume in that gap. Again, what did we say about what is price going to do, or what is the market going to react to based on volume after a gap. And so, yeah, we see this big volume on the earnings, and then we still see large volume, right? A rise in our average of volume after the gap, and that is a sign of continuation. Island reversal gaps, again, one of the rules is that price will return in this whatever time frame that you see them in to that intermediate or near-term level of support, or the origin of that move. And you can see that this kind of our origin of our move here was this large green candle, and you can see that price came all the way back to that level. So let's look at another example. So here's Tilray. And again, here's one that is of a longer extended, right, and low volume, low volatility. And there is a significance to this one. So what I'm going to do here is I'm going to change my scale here to logarithmic so you can kind of see this a little bit better. And what you can see is this one now has a lot more significance to it, right? Because it's come after an extended downtrend and now has created this island reversal. Now, sometimes these island reversal gaps will create patterns of V's and W's. Now, these two are more significant when we look at a larger price pattern. And so here's snow. You can see that here's an island reversal gap, and you can kind of see that W pattern, right? And so this would be a significant, could be a significant bottom. Again, you know, if I look at this in terms of price action, right, and we look in the much bigger picture, we're really kind of seeing that we're in the lower range of where this stock has been over, let's say, the last year. So there's a higher probability that this low has been set in, and that price will probably move higher from this range. Now, what might happen in this scenario, because we're not getting that follow through, we're not getting that volume distinction, is that we might come back and retrace to the gap. Now, I want to make one note here while I'm on the volume, especially when we start looking at other volume assessments. Right now, I have my chart set at real time, which means that we're getting our data from the CBOE BATS. And so, unfortunately, their volume calculations is about 1/10 of the whole volume of the market. So if you're looking at intraday volumes and you're using real time, your volume is not going to be up to date. But if you're looking at end of day volumes, then it will be complete. So one of the things you can do in terms of looking at volume data is go where it says more data, and then you can look at your current volume and your average volume to make some of those assessments, right? So that's kind of a little tip for you, especially when we're going through this demonstration. You might say, oh, well, there's no volume there. Well, that would be one of the reasons why, okay? And I'm going to show you that again in a little bit. All right, so I've demonstrated to you a lot of different types of gaps. And what I kind of want to do now is let's revisit breakaway gap. And why? Because remember, breakaway gaps are very significant because they represent this large profit potential as price gaps and goes, right? As price makes this new trend. So what we're going to do is we're going to go to our gap page. And now if you don't know where that is, under stocks, you can see a page. It's called gaps up and gaps down. And what we do here is now we sort by a percentage of how much market moves in terms of gaps ups or gap down. So you have that choice. Now you can do some simple filtering here. You can filter based on the exchanges, market cap. Here again, volume is a great tool as a way to measure the strength of a gap. But when I think about gaps, right? And what I say to you is we want to find that first gap, right? Where price breaks away from a range of price or a structure, or to find a gap of proportion. In other words, size and volume. So first of all, if I think about a range of price, right, as a trader, well, if I get a new monthly high or I get a new 4-week high, to me, that's a sign of strength, right? That is a sign that price is breaking away from a range of price from, the previous month. So what I'm doing here is I'm screening on the gap up page. And the first thing I'm going to do is I'm going to look at new highs. And I'm going to do a new high date. And I want to know the new high date for 1 month. And I want to know, is one of the stocks that I'm looking at today making a new 1 month high in this session? In other words, today. So now what I'm done is I've sorted by these gap ups. And now I'm going to say, hey, let's see if I can find one that is breaking out of structure, breaking out of a price range. And 1 month is a good starting point for me. The other thing we said is, let's talk about proportion. So what I'm going to do is I'm come in here where it says gap and range of price. And I can come in here and say gap up. And I'm going to add that to my filters. Now, what value do we put in here? Well, in the theory of price, in theory of market price, what you'll notice is that on any given day, price will kind of fluctuate up or down, 0.5%, 1.5%. That's kind of the range that you normally see. So you could put this at like 3%, 5%, 10%, but you're going to see only a very small amount of gaps. So in my experience is any market that moves about 2%, that's significant enough, right? It's enough that it's outside of what is normal on a day-to-day basis, but it's greater that it's probably going to see that these are the types of gaps that we want to look for. So you can see I've only added 2 filters here, and I'm going to look at my results. Now, before I go away, I do want to do this just to give me a little bit less candidates. I'm going to get rid of these non-commons and these OTCs, like these lower value stocks. And we get only 13 candidates. And I looked at the couple of the candidates that came in today, and you can do this process at home if you want and check it out. So one of the things we can do is we can go to our flip charts and then just visualize, is price breaking out of a range of price? Is it breaking out from a structure of price? So here's Rocket Pharmaceutical, and you can see, right, this really is that example, right? A big, large gap, a price is taking out several recent highs. So this would be definitely a breakout candidate. Now, at this point, you could just take this trade, right? You could just go long on this trade. And then your initial risk would be, again, that failure, that gap fill. Now, that might be too much risk for you. So one of the things we can do here is we can go down to a lower time frame. Now, I'm in a 6-month daily candlestick chart. So I'm going to go down to a lower time frame. I'm going to go to a 5-day, 30-minute chart. And what we want to do here is we're going to try to eliminate some of the risk. And so what did I say to you on that discussion of a breakaway gap, that gap and go? So we'll wait for the first candle, right? That first half an hour, that first hour. And we want to see if price can regain, right? There's usually this initial fade that you get. We want to see if price can regain or recapture, the opening price, or even regain the high of the opening range. And that would be a confirmation of a continuation in price. Now, what we would do then at this point we'd probably buy above here or above here, and then we could use the bottom of this opening range candle to set our risk. That would give us a lot less risk. The theory being is if price falls back inside of this range, it's probably going to fall all the way back. So this is a way we can use lower time frames on the day of one of these breakout gaps to kind of manage our risk. Now look at this one is, I think this is Sigma lithium. So here is really what we want to see, right? That opening range candle and then regaining, right? Regaining and taking out that opening range candle. So this would be I would be more confident in a continuation of this gap and go over the next few days because of the characteristics of the price action that created this breakaway gap. So from this point now, what we can do is we can also start thinking about some other technical analysis to help us with our process in some technical tools. So what do we say? We want to look for those that are breaking out of a range or defining a range. So one of the tools that, what I did was I created a template for this webinar, and I called it a Breakaway Gap template. And so let me just show you what are the tools that are in here. So the first one is something called a turtle channel. Now, a turtle channel is a very easy tool here to understand. Basically, what you're going to do is you're going to define a range of price over a period of time. So in this case here, if I'm using a daily candles, I'm using a period of time of 21 days. So now what I'm going to do is I'm going to define the high of the last 21 days and the low of the last 21 days. Now notice that your range, you can use the high and low, or you can use the close. For this one, I think it would be better if you use the high and low. And so what we're going to do is we're going to see, is price breaking out of these high and low ranges when we look at these gaps. Now what I did was I also reconfigured my tool here. I changed the colors. So my outer bands of my turtle channels are my green bands. And then the other thing we said was this proportion or this volatility that we see with gaps, right? The size of the gap or how far a price has moved. And so there's something called a Keltner bands. Now these are similar to Bollinger bands. Bollinger bands are based on standard deviations. Keltner bands are based on average true range or ATR. So again, these are measurements of volatility, but what I want to do here is I want to look at a multiplier. Again, here's my period of time, 20 days. Again, to me, that represents 1 month of trading. And my multiplier is how many ATRs. So I think the default for a Keltner bands is like 2.5. But again, I've reconfigured this one, and I'm going to just use 1.5. Now you can play with this. You could use 2, 2.5, 3. Again, the wider the multiple you're going to get, the less candidates you're going to get. But what I want to see is that when I get one of these 2% gaps, is that gap outside of a 1.5 ATR price movement? What I would normally see in one day, 1 ATR over this range of price over the last 20 days. So again, you can play with this, you can use this, dial this in based on your risk tolerance. But 1.5 to me I think is a good value, is a good starting point. Now again, I reconfigured this one. Purple is going to be my outer bands, and I turned off the midline. I don't care about that. I just want to know that range. So here we can see, for the example on our Sigma lithium here, is first of all, here's our purple bands, that ATR price movement, and you can see that today's gap, that price movement, is outside of that band. And in other words, it's confirming to me that there's volatility coming in the market, and we have made this 1.5 ATR price movement. And then the other is our green line, which represents our turtle channel. Again, what we want to see is a combination of both. We want to see our gap outside of our turtle channel. Again, in other words, telling us that we're seeing a new 20-day high in this case, right? Now, this is a really good tool because it does help us to eliminate some of those, breakout gaps that maybe not have a lot of strength in them, or maybe are not breaking out of a structure that is obvious to me. So here's one that I can definitely see, right? Here's a nice gap here, but we did not get above the ATR and we did not get above the turtle channel. Yes, did price continue to move higher? It did, but in the range of price over the next month or two, right? It never really got going, right? And there's a couple other ones in here you can look at. But this one is more significant now is because we're outside of both the ATR and channel. So let's do this. Let's go back to some of these stocks that I've already found for us based on gaps, and we're kind of doing a little back testing here, a little revisionary analysis here. But let's look at Apple again. And again, let me just put volume on this one. Again, here's our breakaway gap on volume, right? And let's move this to our breakaway template. And right here's our breakaway gap. Our price action is outside of our ATR band, and we were making a new turtle channel high. Again, if we look at this little breakaway gap here, again, right, we're outside of our Keltner band and we're above, the previous turtle high, right? So these would be confirmations that we're going to probably see a continuation of price action, and you can see that it did come out. Now, again, notice that we have these gaps here, right? These gaps here where when price reversed, but they didn't fall to a new ATR level, or it fell below the turtle channel. But here we can see this gap, that breakaway post volume gap, right? Here it is right there. That one did, and that one was the one where price continued in our price. All right. I want to see if let me just check my notes here for a second. Here's our Celsius. Again, this is really what we kind of want to see, right? Our gap that is really outside of the ATR, the Keltner band, and again, breaking out of a turtle channel, breaking out of structure at the same time, right? So you can kind of see that here. And again, right, we can see that as well as we can here. Now here's Lilly. And again, here's that big movement outside of our ATR, our Keltner band, and we're making a new turtle channel high. But let me do this. Let me get rid of volume here for a second, and I want to kind of show you how this tool can help us avoid some of those false breakouts, right? So for instance, here we had a bit of a breakout that did get above the Keltner band, but did not give us a turtle channel break, right? Now, yes, did price continue away? Yeah, it did. But this is probably not a great breakaway candidate. Now, if we look at this in terms of volume, we'll see that there was a spike in volume, but afterwards, post volume, there wasn't a lot, and that was an opportunity if you wanted to get in this trade, is that retracement process. Okay. All right, so I've showed you a lot of different types of gaps. We learned how to discover these gaps and goes, or these breakaway gaps. what I do see is I see a couple questions Gene has passed through to me. I want to kind of get to a few of these questions before we get through our session today. But I also want to start showing you how to putting this together in terms of not only of these gaps and goes, but this retracement kind of idea. So first of all, let me just look at a couple of these questions here, Gina, for a second, all right?
Right. While you look at your questions that I've passed through, John, I've had a lot of people ask, okay, where can I get John's chart template that he used? If you go to our webinar archive page, it's in the Learn tab, look for archived webinars. And if you open up today's session, there's a link to download the slides. It's in PDF format. And John has included his chart template set up for you there. So look for those slides and you'll be able to get a copy, or at least, take a look at how he created those, that template. All right.
Thanks, Gene. Okay, so I see a lot of questions. I think I'm going to answer a lot of these as we go through in the next segment. Question from Dan is like, what does cause price to return after several days? Well, it could be just strength of a commitment or market sentiment, right? We might have gotten some kind of news story that got everybody jazzed up, but then the reality is that those buyers might have been retail buyers and not, or weak hands, and then price returns. But when price returns to that gap, then you might, if that news story is significant or is something that is going to drive our trend over the next few days or few weeks or few months, that's probably where our institutional traders are going to come back in, right? They're a little bit more patient to us. Anthony asks an interesting question about regular trading hours. Now, Anthony, I think I'm assuming you're going to talk about equities here, but we will address the difference between regular trading hours in futures markets. But Anthony, I think, you got to kind of discount a lot of action that is happening in the extended hours, although our screener here is looking at that pre-market session of gaps. So I want to look at that action in the morning, but I'm still might do my analysis based on, let's say, a daily. And then there's another question here from Wayne, is like, what time frames? Well, Wayne, I want to do the gap analysis start at the daily level, but then I showed you how I might go down to, let's say, that 30-minute time frame to look for a way to manage risk. Now, what might happen is when you go from a daily to a lower time frame, you might not see that gap, right? Because remember, on a daily candle on a stock market, the opening price is the opening time of the exchange. So Goodwin asked a good question about, can we use these for all asset classes? Yes, we can use this for all asset classes. And again, I'm going to demonstrate for futures markets a little bit different. What I will say, though, for ETFs, and that's a great transition, so thanks, Goodwin, for asking that question, is that if you think about an ETF is a composite of a lot of stocks. And really, if you think about this imbalance between buyers and sellers, you're talking about a lot of different stocks. But the characteristics of gaps, or the theory behind gaps, do play out in ETFs. Now, what might happen in some of your ETFs that are not actively traded, and I'm not saying like less than 100,000 shares, but I'm saying something like, one of the sector ETFs, you might see a lot of little gaps. Now, I don't have an example here in terms of an ETF, but here's UPS, right? This is an actively traded stock, a bank stock, but you can see there's a lot of these little gaps, these common gaps. Remember, we want to discount those that are inside a structure. What we want to look for is those gaps that are making major moves or making new structure or straight lining away, right? That's kind of what you're going to do with ETFs. You're going to discount a lot of little gaps and look for those major gaps. Okay, so let's go back to the cues here for a second. And this is an ETF, so I hope this will demonstrate what I'm talking about. In terms of what I said in the beginning of the introduction is I've demonstrated here now how to use these gaps and goes, or how to run with price as it moves, but also let's talk about when price returns to these gaps and how these can give us a second chance to enter into a trade. So here we can see a gap up right there. And then price for the next couple of days went higher. And then about a week later, price returned to that gap up, that absence of selling, abundance of potential buyers probably still waiting to buy down here. And notice how price comes back, fills that gap, and then price shoots away. Now, in the intermediate, as we are falling back to fill this gap, notice that there is a gap here, right, between this candle, and that if we believe in buyers, would the market be allowed to gap lower? No, absence of buyers. So that's telling us that there's some selling pressure here. And notice that price came back to where that selling pressure was and then returned. Now, what do we get here? Here's our breakaway gap. Here's our runaway gap. So we can measure that, right? Measuring gap, and that gives us a clue that this could be a topping action. Again, if this trend was going to continue, would the market be able to create a gap lower? Gap lower is an absence of buyers. This is a clue to us that buyers have stepped away from this market. And sure enough, price falls. But notice what happens then when price returns to where we saw that gap. Well, that's exactly where price turned again. Again, now here's another little gap down, little retracement, great opportunity to re-engage this trend. And then down here, right, where price fell dramatically. Now, this is not a textbook island reversal, but it certainly looks like it could be. Here's a little exhaustion gap here, but, big V bottom, gap down, gap up, island reversal. And again, not significant in terms of a major trend change, but what did we say? That when you see one of these island reversals, that the rule is that price will return a retracement to the origin of whatever price movement we see in the intermediate time frame. And did the market do that? Yeah, it did. It went right back to that gap that started this whole sell-off. Now, notice that there was a moment in time where market did come back, fill this gap, and then bounce back. So again, if you were looking for a buying opportunity, you could have been patiently waiting for that gap fill. Let me go to a little bit of the lower time frame here so we can see some of these more recent gaps. Again, gap up, right? Here's a nice gap down where price fell to, right? Where did price find support, right? Right where our previous gap up is. So now price is rallying up, right? So where do we think that we could see this price rally to? Well, I think we can make a good case that we could see the Qs rally back up into this, 376.30 area to, 377 level. At that point, what would we assume might happen? Well, we might see some kind of a exhaustion gap, or maybe we might see a reversal, other technical analysis, maybe we get an overbought signal, but, fill this gap of where price changed direction. Now, I want to show you that we talked about the importance of the size of the gap or the proportion, but I said to you, it's not really about the size, large gaps. That is what the market does after the gap. Now, notice here we see this a dramatic sell-off in the Qs, but we did find a support. Now, why did this price stop right here? Why did it do that? Well, if I go over here to the left at the Qs, there's a red line that is the bottom of that V bottom that we just looked at. Notice what is here. A little teeny gap between one day and another day. So price remembers where gaps are, and price finds these gaps, and these are great entry levels if you believe in trend analysis. So in the big picture here, right, if we look at a weekly chart, right, where we have a strong uptrend, we had a bit of a correction. Where did the market come back to? That little teeny weeny gap, and now looks like our trend is back in control. Okay, so that's the theory behind retracements and how powerful gaps are. And so the next thing that I want to talk to you guys about is a very unique type of gap that sometimes is not as obvious to us. And the reason why it's not obvious to us is we can't see it. There's not really this void in price. It's a little bit difficult. So we have to learn how to train our eye. So these are called inside gaps. And again, these are more difficult to see because there's not this clear void on our charts. Now, these gaps are where the opening price gaps from the previous bar's close. And I think this is kind of the question that Anthony was asking. But we're not outside of the previous bar's range. So for instance, here's where this candle or this bar closed, and then here's where it opened. And so you can see there is a void of price between the close and the open, but this gap is inside of the previous day's bar. So these are typically filled within, let's say, 1 or 2 bars or inside the same day. And these are great day trading opportunities for our astute traders who can recognize these. Now let's go back to our cues, and these two boxes here, these two blue boxes here, are showing us those inside gaps. Again, here's where that candle closed. Here's where the next one opened. Here's a gap that's inside of this candle's range. And this would have been a really good day trade setup where you would try to sell right on the previous day's closing price. Have you ever heard of this expression? Novices open the market, professionals close the market. So we probably know that there are some professional traders that are willing to sell at this price again. Again, if price was allowed to gap down, it's an absence of buyers. So this would have been a great little day trade setup and a way to re-engage what was about to become a very major price movement. Now notice here we do see an inside gap here, but it took 2 days for us to come back and fill that gap. So again, a lot of times they happen within the same day, and other times they happen a couple days later. So that brings us to futures. And so the question is, can we use gap theory in all asset classes? So in futures markets, yes, it's still the same kind of rules, still the same constructs in terms of what I just demonstrated to you. But in futures markets, they're less prevalent. We don't see a lot of gaps in futures markets. And why is that? Well, that's because futures markets are open for a longer period of time, right? Some futures markets are open almost 23 hours, 24 hours a day. And if I'm talking about Forex, Forex is open 24 hours. So you're not going to see a lot of gaps in those two asset classes. But when we do see a gap inside of futures markets, this is very significant, right? This is a major change in the perception of price, or that sentiment of price. And so you can see here, I'm looking at corn, and there are a couple gaps that are very obvious to us, right? We can see them on our charts, and notice the price action that came after that gap. Now, there is this concept when we start looking at gaps and inside gaps, there's a little bit of difference in the way they are created in terms of futures markets. And so a futures market candle, in this case, a daily candle, if I go into copper here, I'm looking at copper, and The opening price of a daily candle will be the opening of the all sessions. In this case, at 5 p.m. of the day prior to the actual trading day. That's called the opening of the all sessions. But the closing price, or the closing value of a daily candle in a futures market, is based on the settlement price. And now the settlement price is usually created sometime inside of the regular trading hours and well inside of the all session. So the all session here is from 5 p.m. to 4 p.m. from yesterday to today would be the example, but the settlement price for copper would come at 12 p.m. Central Time today. So a gap between the opening and closing price in a futures market might not be a gap of imbalance, right? It's more of what we call a session or a time gap. But I will tell you that algorithms and professional traders are well aware of these gaps. And again, novices open the market, professionals close the market. So around closing times, that's areas where I want to think about getting into the market, because I'm getting in with our professional traders. Now, what I would like to do is look for these kind of inside gaps that are with our trends or with the price action that I'm recognizing. So again, how significant are gaps in futures markets, right? Here's a nice gap. Now this is an inside gap, right? But you can see that we didn't fill this gap, but you can see that when price came back to it the first time, even the second time, we did get a bit of a reaction to it. Here is another inside gap right here, right? Where this would have been a nice little day trade setup where you could have got into the short and run this one out. Here is natural gas. Again, there is an inside gap, right? Again, gaps are more significant, right? And then here would be our true outside gap. Now notice on this one, right, outside gap, we could have done that volume structure, breakaway ATR analysis on this one, right? Probably wouldn't have got a good result in terms of risk reward ratio. But notice that when we returned to our gap, this is where the market reacted again. So both rules here, right? Outside gap and then that retracement, right? We didn't get a great breakaway structure, maybe not a lot of volume in this one, but here we get that second chance, right, to get into that trade. Okay. So let me see if there's any new questions here, a couple. Robert asks, I often heard that 80% of all gaps get filled. Well, I believe in the theory that all gaps are eventually filled, but yeah, I think there's a much higher percentage that you will see that gaps will be filled, especially within a relative time frame. In other words, if I'm looking at dailies, within the next, 3 to 6 months or something like that. If I'm looking at a gap that was created a couple of years ago or 3 years ago, then I'm not going to really look at that gap. I don't think it has as much relatives. I think the gaps that are being filled within a shorter period of time frame are the ones that are more relevant to us. Okay. All right, Gene. Let's do this. Let's sort of sum up our session together. And so inside gaps here, one of the clues we can look for is, as we look for 2% for breakaway gaps, look for those kind of gaps that are less than 1.5%. And again, you could do that with our gap up or gap down page. Again, I kind of want to find those inside gaps that are with my trend. But you can find a lot of these inside gaps that are the beginning of a reversal of trend. But I want to make sure that I have a good risk reward ratio to allow me to take that trade. Okay, so what are some of the takeaways? Well, remember that gaps represent this most significant imbalance between buyers and sellers, right? A gap is an absence of buyers. A gap is an absence of sellers. And that when price returns to that level, there's probably, buyers or sellers that have been waiting patiently to re-engage what caused that imbalance. But again, also a gap could signify to us this beginning of a new trend, or this affirmation of a trend, or in some instances, maybe even that reversal, as they demonstrated with the Apple example, which was a very small gap that came on a trend line break that several days later was the beginning of a new price movement. And then there's that sequence of gaps, right? In trends, they kind of follow this breakaway, runaway, exhaustion, and then you get that reversal. Not necessarily always get a reversal, but you can see that there is this consistency of this gap. And if you know where you are in the gap cycle, again, you can do that. It can help you with your risk management in terms of price targeting. Remember, gaps act as magnets and try to draw price in, especially after a couple of days or a few days. And there you go, Robert. I still believe that all gaps are eventually filled. And gaps are more commonly found in equities than in futures or Forex because of the limited time equities are open, right? You think about the difference between regular trading hours for the stock market, 9:30 to 4 o'clock Eastern time, versus the regular trading hours or the all session hours for futures markets. So that also, again, plays into this in futures markets, in Forex markets. If we see gaps, they are much more significant. And I see another question that came in here about, can we see gaps in higher time frames? Yes, like for instance, weeklies. You're not going to see a lot of gaps in weekly time frames, but again, the higher the time frame, the more significant the gap. Okay, so I think I got a little bit over. I apologize for that. Here's what Gene was talking about. There is my template settings that's in the files, so you can see the settings for that template. And some of the stuff that the screeners that we do, I didn't show this, demonstrate this, but you could set up a screener based on those two probabilities that I just laid out, volume and percentage. And Premier members, we can send that screener to ourselves, and you can get a morning one at 9 o'clock, and that would give you those candidates that allow you to do that assessment early in the morning, which is a really nice feature of being a Premier member. So again, you can try out Barchart Plus or Barchart Premium for a 30-day trial period, and I would recommend that you do that to just give yourself a chance of finding some of these great trading opportunities. Okay, Gene, I think that's enough for today. What do you think?
Yes, and if John did not get to your question today, there's been a lot of questions coming in here. Please email support@barchart.com. They'll be happy to assist you, and if necessary, they'll get a hold of John and see if he can also help with your questions. All right?
Exactly. Yes, exactly. Okay, Gene, thanks for a great session. I hope everybody enjoyed this. Please come back. Next week we're off, but we got some really cool sessions coming up in the next few weeks. So stick around, watch, and check out in the upcoming webinars to see if something strikes your fancy. Until next time, folks, be safe out there. The best of health and the good of all trading.